Welcome to the Daily Update, where I'll go over the action in the market for Friday, July 7th, and then we'll see how things look for Monday, July 10th. We had kind of a mixed day. We pretty much ended about where we started. We were looking more positive during the early part of the day. Looked like we were starting to break out. Things were really trying to improve. And then we hit some upper resistance and then spent the afternoon just coming back down. And we ended up closing down just a little bit on the day. We're still maintaining a positive posture overall. But again, if we see more continued weakness to the downside, that's going to deteriorate. But for right now, it's holding up. So what are some things that we can talk about? First, at the open, we did have a higher open with initial support being provided at the daily pivot at 44.06 before prices went above the unchanged level, and then we climbed up to R1 at 44.28. As the day went on, prices climbed above R1. We never got up to R2. We hit resistance at 44.40. Then that was pretty much the high, and we started declining after that. We went down below R1. We went down below the daily pivot. We even went down below the unchanged level. We closed negative and at the low for the day. We were down 0.29% on below average volume. That's another thing that still is happening right now. And we might see that throughout the summer months because people are going to be gone. The market's kind of indecisive right now as to what it wants to do, and that produces lower than average volume. The technicals were still positive overall. We're hanging on to some really good things right now, but we're going to lose those if we don't see some upside action here pretty quick. The real scenario is inflation and interest rates, and that also feeds over into growth concerns that may be happening economically. What are some comments that we can make? Mega cap weakness really dragged down the S&P. Now, they were stronger in the early part of the day, but as the day went on, people started to take profits in the mega caps, and that dragged the indexes down. Fortunately, the broader market was still a bit more positive. Value and small cap stocks did have a pretty good day, but growth didn't necessarily have a good day, and that's what we like to see when we want to buy low and sell high. On a short-term basis, we're still keeping an eye on our stochastics being overbought. The oscillators are still looking a little bit toppy, trying to chop around, deciding what they want to do. And we have the Sean trend meter, which is going back into its initial overbought condition. And believe it or not, we have the Stoch RSI on a short-term basis is actually oversold now. The dollar was down and interest rates were mixed. That's been kind of the story the last couple of days, is really keeping an eye on interest rates. We still have all of our yield curves that remain inverted. Sentiment is still extreme. We're at 78. When we get down to 75 and below, that's where we drop into positive territory. When we're above 75, we continue to be extreme. Our trend is still positive, but it's declining. The ADX is still dropping below the moving average. The green line is on top, but it is declining overall. However, both are still above 20. Our bias is negative because we've had 2 down days now in a row, and I'm keeping our momentum at mixed to more negative, even though we looked more positive earlier in the day. The economic reports that came out. This was the big employment situation report. We had non-farm payrolls come out at 209,000, less than the 220,000 they had expected. Last time we had the report, it was at 306,000. Private payrolls came in a lot weaker than expected at 149,000. They expected 210,000. Last time we had 259,000. The unemployment rate was at 3.6%, which is what they expected, and a tick down from the 3.7 that we had last time. Average hourly earnings came in at up 0.4%, more than the 0.3% that was expected. Last time we saw a reading of 0.4%. On a year-over-year basis, this equates to 4.4%. The average work week was up to 34.4, where it was expected to be at 34.3, the same as what we had last time. Here's some charts showing how the non-farm payrolls are performing. It's a little bit hard to get a lot out of this chart because of the big swing during the whole COVID plunge. And then the unemployment rate did tick down just slightly. Here's another chart of the unemployment rate down to 3.6. And then showing the initial jobless claims, which is the red line, they did decrease this past week. Continuing claims are also declining, and the unemployment rate also ticked down to 3.6%. Here's the average hourly earnings, which are pretty much flattening out but declining slightly. Then the payroll change did show that it came down from the previous month, but we're still seeing positive growth anyway. Looking at some IsabelNet blog charts, it says years with a big first half tend to consolidate around now. And that's kind of normal. Around July, we're seeing that a lot in our historical data as well, where the orange line shows when we're up 10% year to date in June, which we are. And then this is how we're performing so far, where we tend to flatten out going through the summer months. We might see a little bit of weakness into the fall, but then we typically see a good end to the year. Now, that's just historically what has happened. We can always go against that. Then looking at the performance of the S&P around recessions, going back to 1945, this is the average overall, where once we get back to being more normal with no more inverted yield curves, this is when we start to see some weakness coming into the market. But we're not at that point now. Then the deviation, either above or below earnings, we're still above. And the earnings are quite optimistic. We don't know if they're going to continue to go up. At least that's what the forecasts are. But then we have to see what the reality is. And then the S&P breakout plus success of a retest where we had come out, broke above these two blue lines, came back down, and now we're coming back up again. So that's called a successful retest. And then looking at the presidential cycle, we also have the decennial pattern and years ending in 1 through years ending in 4. The orange line is the presidential cycle, and that's what we're in right now. And this tends to be more positive overall. Then we have the decennial cycle from 1 to 4 years. That's the blue line, which is also positive. All presidential cycles are the purple line. And then the current cycle back here, we're pretty much performing similar to how we have performed in the past. Then looking at the cash allocation against the long-term average, this is the folks that are in cash, where the blue line is the average, and we're a little bit under that. And then here's the latest read for GDP now, where we're looking at 2% all the way down to about minus 0.5% from the forecast, but the green line has us up a little bit over 2% currently. The active asset managers came out with their latest survey after the big update that we saw last Friday. They did show some more optimism and we're above 83, so we're looking a little extreme with that. And then the debt allocation, it's currently at 21%. These are folks that are in bonds. It had been really increasing, but now it's starting to roll over slightly. Looking at our charts and analysis, here's the intraday chart where we had a flat to kind of positive open. We came down to the daily pivot. This set up some initial support before we got set to go higher. We got above R1, then we hit this upper resistance, or we just kind of fizzled out at the 44.40 level. And then we started to come back down below R1. We came down below the unchanged level, below the daily pivot, and came down and closed at the low for the day. Here's the SPY intraday chart where we were pretty much flat in the initial overnight session. We gyrated around, but were more negative in the pre-market session. Then after the open, we saw a real improvement, only to see that weakness coming in. And as the SPY stops trading for the week, we're pretty much flat. Growth is now underperforming value, where both were down, but growth was down even more. That's the blue line, where it went down more than the red line. So on a closing basis, growth was down more than value. It underperformed with the mid caps as well as the small caps. And then the growth to value ratio, we were under the unchanged level and did show some weakness. Looking at sentiment, our Ulcer Index just hasn't changed all that much, showing that there's not a lot of fear. We ticked down slightly with the line chart and the bar chart. Volatility has ticked down slightly after the employment report came out. We're still keeping an eye on this chart, which is the correlation between the VIX and the S&P. We're above the dashed line now. We don't know if we're going to continue to go up or if this is going to top out and start to come down. Typically, this has been more negative than positive, but we'll just keep an eye on things. The SKU index, after almost getting up to this extreme reading, is now starting to come back down. So maybe the big move that the market had been anticipating is over with. We'll have to see if this continues to go up. The equity put call ratio was up slightly with the down day, but longer term, our equity put call ratio is still declining, and that is positive. The VIX to move ratio is also showing that there's not a lot of fear. Then looking at the move index, which measures the volatility of bonds, that has really spiked up. We saw a little bit of a move up with the VIX, and then down at the bottom, we can see where the correlation is pretty strong between the two. This fear gauge is starting to tick back up, even though we're still in an overall decline. We're also declining with this other fear gauge. Folks are still favoring a risk-on posture, meaning they prefer stocks over bonds. Our advanced decline line, with the down day, we saw a little bit of a decrease based on price and value. And the new highs, new lows are starting to roll over with our 5 period, and we're declining slightly with our 10 period. The advanced decline ratio continues to decline, but is still above 0. Accumulation distribution is still above the moving average, but it did decline on Friday. We saw a little bit of improvement in the broader market, where the cumulative advanced decline line for the NYSE did show a nice little upward move, and our other advanced decline line ticked up. Then the other advanced decline line that we follow is still above this upward sloping trend line. When we look at common stock based on price, we ticked up slightly as well as with volume. And then our advanced decline line studies with the NYSE showing some improvement. The S&P was flat, a little bit of improvement with the mid caps, and the small caps where they're just barely above the moving average. Our trend just shows how the ADX is below the moving average, so this suggests a weakening trend. However, we still default to the positive. The green line turned up a little bit, but since it's on top, that's what we use as our backdrop. Our shorter term ADX indicator also showed a little bit of a turn up with the green line, but also a weakening trend. Volume continues to drop off. Our short-term charts, where we didn't really decide all that much based on the bar chart, and then on the bottom, we did see below average volume. Looking at the double and triple exponential moving averages based on 20 periods, we're still below both moving averages. Our 20-period exponential moving average continues to decline. We were pretty much flat with the 50 and actually ticked up a little bit with the 200-day exponential moving average. We're still above the other 20-period moving averages that we follow. This is short term, and as long as we can stay above this, the market maintains more of a positive posture. The Stochc RSI is already extreme negative. The stochastics coming down in the short term and no longer extreme, also coming down and no longer extreme in the intermediate term. Our longer term stochastic is rolling over a bit, but we're still extreme positive. The force index is still above 0, but it is declining. Intermediate term charts, we're declining with the balance of power, but we're still above the dashed line. We're looking at the double exponential moving average is still providing support based on 50 periods. And the go-no-go system is switched back more to neutral with the lighter colored blue bars. The TTM squeeze continues to show some weakness, but is still positive. We're no longer extreme with our standard deviations chart. We're coming back down into the 1 standard deviation area. The PPO continues to be positive in the long and intermediate term. We're still above 0 in the short term, but we are declining. The Erin, after giving us an extreme positive reading, is starting to come down with the oscillator. Looking at the S&P McClellan oscillator, we've dropped below 0, so that's a little more negative. We're starting to turn down based on price with the summation index, and we've already been turning down based on volume. The NYSE McClellan oscillator did go back above 0, so that's a little more positive. It's also some improvement with the summation index based on price and volume. The Swenlin trading oscillator is declining based on price and volume, but still above 0. The PMO is trying to roll over more negative. We're turning down based on price, but still positive. We're starting to cross over negative based on volume. The PMO study shows that the PMOs that are rising is decreasing slightly. We're starting to come down with the buy signals, and we're flat to slightly higher with the PMOs that are above 0. The elder impulse system for the S&P remains neutral. The slope indicator still is more negative, and the MACD is also turning back to being more negative. Looking at all of our oscillators, short term, we're looking at more negative. Intermediate term, we're rolling over a bit. Long term, we still continue to be flat with a slight downward bias. The parabolic SAR is still positive with the dots underneath, and we're still above all the moving averages in our moving average tree, hoping that this might provide support. The Sean trend meter ticked back up just slightly and is barely in extreme positive territory. The bullish percent index continues to hold up. We're not getting an extreme reading yet, but it is hanging in there for right now. The NYSE bullish percent index ticked up slightly and is above 50. The Chaikin money flow continues to be positive overall, and this tries to read institutional buying and selling. The Chaikin oscillator did tick down but is still above 0. The money flow continues to decline but is above 50. The ultimate oscillator is also declining but still above 50. The vortex shows the green line coming down and the red line going up, but the green line is still on top. The RSI for 14 periods is declining but still above 50, and we're seeing that same reading with the RSI 9 period. On balance volume is starting to drop below the moving average. That's slightly negative. We saw a little bit of a tick up with our 200-day moving average study, and we were pretty much flat with our 50-period moving average study. This is also that same chart. Our Fibonacci studies and lines just have this chart where we're still hanging into support of the high when we look at the 20-period simple moving average. Our different charts, the Heikin Ashi is looking a little more negative. The Kegi is back to pointing up, so that's positive. The Renko continues to be positive, and the 3-line break is also positive. Our different indexes, we ticked up slightly with the equal weight, but it's still underperforming the S&P. The equal weight did tick up when compared to the S&P, and so far is hanging in there. This is another area that I was watching really closely. The transports were actually above this previous resistance level, but we closed down below that. But we did see some improvement. The utilities also showed some weakness. And then our transports to S&P 500 ratio did increase slightly. We want to see this going up to give good support to the market. And the relationship between the S&P and the transports continues to get stronger. And the transports are pretty much back up with the Dow. Our equal weight discretionary and staple study, we were up slightly with discretionary. We declined slightly with staples, so we saw a little bit of an improvement with the ratio, and we continue to be in an uptrend overall. The Dow is still hanging on above its 50-period moving average, although we did drop down below this pivot level. We have turned negative now with the diamonds. The NASDAQ, we're still kind of in between that. Are we going to break out or are we going to break below support area? Thursday's bar looked a little more positive. Friday's bar looked a little more negative. We're still keeping an eye on the 61.8% retracement level. We have not been able to break out above that. The NASDAQ new highs minus the new lows on a cumulative basis continue to show weakness. And we're still just barely positive when we look at the NASDAQ new highs minus the new lows. We're still dealing with this previous high with the NASDAQ 100, and we're below that level, but we're still above the pivot. The Qs have remained at neutral. The NASDAQ 100 BPI was pretty much down to flat. The Qs are outperforming the Dow. Small caps were up 1% based on our small cap index, and we were able to get back above this pivot level, and we were able to stay above this pivot level. But we've kind of worked our way back into this conglomeration of prices where we've been before. The small cap index based on the Russell 2000 did generate a recent golden cross. We're turning back up slightly with the RSI above 50, but the MACD continues to be negative. The small cap Elder Impulse system has switched back to neutral after it had been negative. The small caps continue to underperform the S&P. When we look at small cap growth to value, we are seeing some weakness here, but we're still in an uptrend. The mid caps also had a pretty good day, not up quite 1%, but remain above support. And we've switched back to neutral for the mid caps for the Elder Impulse system. Mid cap growth still is in an overall uptrend, even though it did decline on Friday. Keeping an eye on the financial sector, we're still above the 200-day moving average, but even though we're seeing some improvement with the financial sector, it's really underperforming the S&P. And the regional banking ETF ticked up slightly, but is still underperforming the financial sector. Bonds, we saw a real spike up in yields over Wednesday and Thursday. We saw a little bit of an increase on Friday. When yields go up, that means prices go down. We're below the 200-day moving average with the bond ETF. but folks are still favoring getting into riskier bonds rather than more conservative bonds. This is another area that's a concern. If we were more certain about interest rates, this ratio would be going down. Instead, it's going up, and we're starting to see a golden cross with this ratio. We're still above the 2007 level set just before we went into the great financial crisis. Long-term analysis, we're still positive with the daily chart using the special K. We're still negative with the weekly chart using the special K. Wanted to show our longer-term moving averages. We ticked up slightly with the 150 and 200. Then I haven't shown this chart in a while. This is the breakout above the trend line. I'm not showing this chart as much because we're leaving this behind time-wise, but it continues to hold up nonetheless. The MACD is still positive. An update of our possible positive scenarios. We're still above zero based on price and volume with our 19-day exponential moving average of the advanced decline ratio. Saw a little bit of improvement with the Qs to S&P, a little bit of a downtick with discretionary to S&P, and we're still hanging in there, but a little bit of weakness with large cap growth versus large cap value. When we look at our growth to value ratios, a little bit of improvement with the large caps, showing some weakness with the mid caps and the small caps. The S&P to utilities ratio continues to go up, but it's not giving an awful lot of support to price. When we look at our broad range of the highs minus the lows and take a 5-period moving average, we are still above zero. When we look at the 10-day average of the S&P 500 highs minus the lows, we're still up in this extreme positive area, and we've been hanging out here for a few days. The 50-period moving average of the new highs minus the new lows ticked down slightly, but is still going higher, and our indicator is still slightly above zero. When we look at S&P growth to value, this is a little bit of a concern, even though we're still in an uptrend, but we are seeing a decline overall. The Staples to S&P 500 ratio ticked up slightly, but still are really underperforming, which could give support to the S&P. So what's our outlook for Monday? The technicals are positive, so we still have that stance. Support still continues to hold, but if we see further weakness, it's going to switch things back more negative pretty quickly. As far as the economic reports coming out on Monday, we'll get wholesale inventories as well as consumer credit. Neither one of these are real market movers. And then we're keeping an eye on the geopolitical events. The markets are really fixated on inflation and interest rates. Is good news good news? Is good news bad news? We're still trying to play that whole scenario out. Here's the updated calendar for all the economic reports that will be coming out in the upcoming week. Here are the updated statistics for the Stock Traders Almanac for July 10th, where we're neutral to positive pretty much across the board. We will be on the 5th trading day of the month, where now after this is when we tend to see more sideways action historically. Then in the middle of the month is typically when we might see some weakness. We're still keeping an eye on the NASDAQ, which tends to perform well up into the middle part of July. So our scenarios, hard to go with the down one now, even though we could turn more negative if we see some downward action, but our technicals are still positive for right now. Support is holding, but if we see a lot of selling, this will switch things more negative. We're still positive overall, so we're going with that. The green line is on top of the ADX, so we default to that, even though the trend is weakening. We can't go with the sideways trend because even though the trend is weakening, we are still in a trending environment. So our warning signs, the VIX is still continuing to show a lot of complacency. It's acting kind of strange, which is why we're looking at the S&P to VIX correlation chart. The cumulative new highs, new lows for the NASDAQ continue to show weakness. We're still above the 3-month yield going back to 2007, which happened right before we saw the big great financial crisis. The S&P growth is weakening, and I put that on this list. We're still in an uptrend, but it's just not performing the way we would like to see that. And then earnings season can be either positive or negative depending on which company reports. Our positive signs, we still have seasonality and setups that remain in the background, and I'll cover those again in the weekly video. The daily chart for the special K is positive, where the weekly chart is negative. The longer-term equity put-call ratio continues to be positive. We're still above that downtrend channel upper line. We're still in a risk-on posture. The transports are now improving. And now are we going to turn back up and try to deal with that resistance level again? Lower price levels so far have been providing support. The S&P is outperforming utilities. The NASDAQ and NASDAQ 100, we're keeping an eye on that. We have the 61.8% fib retracement level for the NASDAQ and the previous high for the NASDAQ 100. The Staples to S&P 500 ratio is declining, which could give support to the S&P. The Russell 2000 index did generate a recent golden cross, as well as the mid-caps. Small and mid-cap growth continue to be positive, even though we saw some weakness on Friday. So what's our conclusion? Overall, the S&P, it's still positive, but it's going to turn negative if we see more selling pressure. In the short term, we're still positive for right now and not necessarily overbought. Intermediate term, we're still positive, but we have to see some follow-through buying. And long term, we still remain positive. Thank you. I will be preparing the other videos over the weekend, so I hope you have a great weekend, and I'll talk to you in the next video.